When it comes to investing, time can be your best ally or your worst enemy. Investors have gone through major market volatility in the recent years, and the question is how to navigate the ups and downs and ensure that your investment is exposed to as little risk as possible. Joining us to discuss navigating this market volatility is Rupert Giessing, Director at Vista Wealth Management. Rupert, thanks for your time. I think post-Brexit and even leading up to it, there's been a lot of market volatility. What are the things that you're saying to investors now? And how do you handle this situation? What should we be doing?
Oh, to be sure, yeah, thank you very much. I think that the same principles should apply during normal times or good times as they should during volatile times. And that's going to come down to investors having to have a formal investment plan, taking into account what the objectives are, and also most importantly their time horizon, because that will then determine your asset allocation strategy for your portfolio. And by doing that, you will determine how much exposure you need to risky asset classes like equities, for example, which in turn will lead you to be able to reduce your exposure to those asset classes as much as possible, thereby reducing risk in your portfolio.
Certainly what we've heard is, buy low, sell high. Seems very simple to
Easy,
do.
yes.
And during these, very interesting times, we've certainly seen the stock markets come under some pressure, and then we have seen bounce back. So is it possible to time the markets and really get this right?
That is the question that everybody is always asking, and certainly from a financial point of view, and I think to the average investor out there, it becomes very, very difficult to try to do that. Markets, by their very nature, are extremely unpredictable. During times of volatility, even more so. So what's going to end up happening is the average investor out there is probably going to get it wrong a lot more than they're going to get it right, meaning that over the long term, they're probably just going to lose money by trying to time the market.
So this is where time is on your side. So we've had interesting times during the 2008 financial crisis. There must have been some lessons that we would have learned from there. I mean, if you look at that particular financial crisis and other ones that happened before them, what can we take away?
We've definitely learned some very valuable lessons from the market crash in 2008. We did some market research, and what we looked at, we took a period of 10 years, 120 months, starting in January 2006 up to December 2015. And what's very interesting there is over the 120-month period, 5 months contributed 1/5 of the total return over that period. Total return from a cumulative point of view was approximately 270%. So if you weren't invested in the market for only the top 5 months, you would have lost out on 1/5 of your total return, meaning that your portfolio would have underperformed the guy that just stayed invested in the market and kept calm by approximately 20%. What's even more interesting is 3 of those 5 months, on average each contributed about 10% return individually, but those 3 months, 3 of the 5 months followed the market crash. So it happened in the first 6 months after the recovery of the 2008 market crash. So what happens is investors will start panicking, as we're seeing now with Brexit again as well. They will exit the market, and there's always a bit of a delay in reaction, obviously, so they would have locked in some losses. Now the market starts picking up. Your initial recovery happens very quickly, and now imagine if you lost out on those top 3 days that happened in the first 6 months, or the first 3 months that happened during that 6 months period, you would have lost 50% return. So the best thing to do, and I think the key lesson that we learned from 2008 is like during times of uncertainty to just stay invested. And if you've got a proper investment plan in place, then you shouldn't be panicking and worrying about what's happening to volatile asset classes.
I can understand if if you're maybe 20 years old and you're starting to invest, you've got time on your side.
Yes.
They always talk about what your time horizon is. But what if I'm 2 years away from retirement? What then? What investment strategy should I now be putting into place, and what should I be doing then?
I think for the average investor and man on the street out there, it's once again going to come down very much to financial planning and having a plan in place with certain goals and objectives. If you've got your plan in place and you know that you are 2 years away from retirement, then what should be happening is you should have already been reducing your allocation to those risky asset classes. So it shouldn't have that much of an effect on you if you plan it right. The problem, I think, comes in when it doesn't come right, when you haven't planned it right and you have now locked in those losses during the volatile times. And not that past returns are obviously an indicator of what will happen in future, but I think if we can learn some lessons from history, it will be that it is better to just ride it out, because over the long term, you are going to be better off.
Later on in the show, I'll be joined by a panel of experts, and we'll be talking about, gold mining stocks and even gold mining in general, which to be invested in. Some interesting moves we've seen in the bond market. Those yields globally have been a lot lower. Just really interested to get your analysis of what we've been seeing in these different asset classes. Again, you said you've taken, some of the lessons that you've learned over the past couple of years, but in the situation right now in terms of asset allocations and investment strategies, what to do? What's the best thing that you could say to us now?
That's always an interesting question. I think the key from a portfolio management point of view is always going to be about diversification. You don't want to have all of your eggs in one basket. So you should be ensuring that you are diversified and moving away from, let's say, volatile equity classes like equity, going into safer areas, bonds, for example, as you're getting closer to your objective and your time horizon is getting shorter. So if you are invested in the market and let's say you've still got a 10 or a 15-year time horizon, then by all means you should be invested in those risky asset classes, because that is where you are ultimately going to get the most growth and returns from in your portfolio. So that would be crucial from that point of view, but then gradually reducing it and doing your review every year annually and making sure that you're on track to meet your goals.
Okay, so you've got diversification, you've got to review annually, see where you are, and
yes.
The closer that you're getting to that investment goal, you might maybe want to start to relook and maybe
Correct.
Not as risky,
Correct.
especially if you're nearing retirement.
Correct, yes.
Rupert, thanks for coming. Lovely to have you on the show today. That was Rupert Giessing, Director at Vista Wealth Management.